Welcome to Tradiers, the Trader's Edge. I am Jim Iuorio. That's Bob Iaccino. Thank you guys so much for joining us. We really appreciate it. Thank you also, too, for the subscribers to our newsletter. We take a lot of the topics we talk about on the Tradier platform and break them down even further on the newsletter. You guys that have gone to the Unfiltered Investor, thank you very much. Normally, we talk for about 2-3 minutes before we bring the guest in. We're not going to today because we're having major technical difficulties, and that's why we're coming to you about 20 minutes late, and we're going to do a tight 40. And we have the one thing I will say that I will not skip is that you guys can think Bobby and I are full shit, but one thing you cannot deny is that our 25 years each in media has given us some really good guests and really good contacts, and they say yes. We don't know why, but they do. Let's bring in the president, Grand Poobah of Bianco Research, one of our favorite guys, Jim Bianco. Jim, did you see the AI generated picture that Trade Cheetah had of you? Did you see it?
No, what was this?
Well, Trade Cheetah, Max, our producer, like he generated an AI picture of you for the promo.
It's on Twitter.
That's a fantastic picture.
Oh yeah, I'll definitely look at that when we get off.
You look literally looks like the Terminator Arnold Schwarzenegger version of you.
I have a 400-pound exoskeleton underneath all of this, right?
That's what I think. Right. Okay, you guys who watch this show, thank you very much for watching the show. We normally do our fun, frivolous banter, some malarkey, and a little bit of tomfoolery. We're going to skip through that tonight because I think we got there's a shit ton to talk about. Nvidia just posted they beat on revenues and their stock's up a hair. Is that correct, Bobby?
Well, I'm seeing them at about trading in the post market at about 130. Let's call it 138.86, and I have the close today at about 134.81. So yeah, up a little bit.
I'm an idiot. I have Tesla up. I have Tesla up looking at it. Yeah. So let me get to Nvidia real quick. Because this is for my,
I'm sorry. How much is Nvidia up again?
$4.44, which is 3.25%.
Yeah.
Yeah.
Okay. All right. So let's put Nvidia to bed. Nvidia is important. Y'all know it's important. Everybody's overcovered it. There's something that I don't agree with Jim Bianco on. And whenever that happens, you guys know it's troubling to me. You seem concerned about a resurgence of inflation. Can you walk us through it?
Yes.
You remember what happened last time you disagreed with him?
I know he was right and I was wrong, but then I don't want to cave the next time, go.
Let me start with the big picture. The inflation cycle turned in 2020. Mm-hmm. That we have gone from the disinflation cycle. I define this as from 65 to 91. 65 was the beginning of the Vietnam War. 91 was the disillusionment of the Soviet Union and the beginning of the internet. 65 to 91, the inflation rate averaged 5.5% a year. From 91 to 2020, the inflation rate averaged 2.2% a year. That cycle ended with COVID in 2021. Now we're in an inflation cycle that we've been averaging about 3% a year. And I think that we are going to continue to see that sticky elevated inflation. Here's the problem with inflation. When you say, I think we're going to have an inflation problem, everybody goes to Zimbabwe. And I'm like, no, I'm not in Zimbabwe. We're at 3-ish% inflation. I think also what you're going to see in the next few months is an uptick of inflation because of tariffs. And you're going to have a positive seasonal effect, base effect. And because last year in May, June, and July, you had a bunch of zeros on inflation, which will be dropping off. And if we put up any kind of positive number above that, you're going to see inflation stay around 3 or 4%. Now, why have I been arguing about this inflation rate being at 3%? Because everybody's hair is on fire about a 5% 30-year. And what I've been arguing is with this inflation rate, with the return of real yields, term premiums going up. If you don't know what those mean, those are risk metrics in the bond market. Let me say this. To quote Aaron Rodgers, relax. 5% is normal. 5% is where we should be.
I hate Aaron Rodgers.
Yeah. Well, everybody from Chicago hates Aaron Rodgers. And now everybody from Pittsburgh is going to hate him too. Right.
It's easy to hate.
That's where we should be. We are where we should be. The problem is, so I think what you're seeing is an elevated inflation rate I think you're going to see inflation move up. I'll give you one statistic or one idea on inflation. April 2nd, Liberation Day, was a line of demarcation for inflation. There was what inflation was pre and post. On the post-inflation numbers, there's two data services that look at like millions of prices on the internet and they aggregate up inflation.
Mhm.
That's Truflation. It was at 1.35%, was what their estimate was for inflation on May 1st. Now remember, they use more goods than services, so they're a little bit depressed. So it's the rate of change that matters. They were at 1.35%. They're at 2.1 right now. So they're up 75 basis points on inflation in 27 days. There's another one called Price Stats. It's owned by State Street Bank. It's the old Billion Prices Project. Roberto Cavello from Harvard University does that. They're showing similar types of numbers as well, that what you've been seeing is prices have been going up on internet listed products, mainly goods, over the last 3 or 4 weeks. That's tariffs. That is even 30% tariff. So that's also going to give you a big push on inflation as we go forward.
So here's my question. Actually, it's not really a question. What bugs me, and I think you're right, but what's going to bug me about this is the second that I hear people saying, see, tariffs caused renewed inflation. Because I argue, and you could tell me if you agree or disagree, that at worst, tariffs are going to cause a one-time readjustment of prices, not what I would call a resurgence of inflation, right? If they cause it at all. We've had tariffs in the past with President Trump that didn't cause broad inflation. They caused some price adjustments that then reversed. And this, again, is assuming companies like Walmart won't eat the tariffs and so on. So are you telling people that the tariffs may actually help with the resurgence or no?
No, first of all, you're right that there is the argument out that it's going to cause a one-time adjustment, and that's it. In fact, none other than Goldman Sachs, Jan Hatzius, wrote this in a piece this morning, that he said that at the end of the year, he thinks core inflation is going to go back to 3.6%. And then the one-time tariff thing is going to roll off. And then we're going to have inflation kind of, dissipate in 2026, and that the next rate cut will be 2026. That's his argument. Now, here's the problem with that argument as I see it. Okay, so now we've pushed off the rate cut for a year, but then we're back to I think the cycle turned in 2020. It will dissipate back to the high 2s to the low 3s. It won't for core inflation, for core PCE is what he's talking about. It won't dissipate back to 1.5%. We haven't been under 2.5% on core inflation now for like 54 months. And everybody keeps talking about how we have no inflation. And prior to COVID, anything above 2.5%, and people were breathing through a paper bag. And now we're 54 months above 2.5%. We're all saying there is no inflation anymore. So it's all about our expectations.
That was amazing.
Think that, I think we're going to stay in this elevated inflation environment. Again, I'll repeat. I think that COVID was the end of the cycle, and that we've turned to a more elevated cycle, and interest rates are reflecting that, which is why I said 5% is normal because of the elevated inflation. And because of the risk of inflation, we're adding back now higher real rates. Real rates is interest rates minus inflation. What's left over, it's now going positive. And term premium too, which is another measure of risk, is building because of that inflation. So we should be at this level of rates.
All right, I'm going to tee up Jimmy for some Fed hate here. So the headline,
Fed hate.
Oh, so the headline from the Fed minutes. Cautious approach, appropriate amid market uncertainty. Fed's well positioned to wait for clarity. Clarity. These guys. Fed officials saw potential for difficult trade-offs ahead. Translation, Jim.
Whole lot of nothing, right?
Both Jims, actually.
Jim Bianco. Yeah.
Yeah. No, I think that the Fed is in a tough spot because I think their problem is they don't like tariffs and they think tariffs are bad. And then they've got Bill Dudley, the former New York Federal Reserve president, basically arguing again, which is a disastrous argument, that the Fed should use its power to somehow punish Trump for tariffs. But then you've got Powell saying it's not our job to do any of that. It's our job to just get, you give us the policy, we work with it. We don't comment on whether it's a good or bad policy. And that's essentially where the Fed is stuck right now, is that they're of the opinion, I think, within the halls of the Federal Reserve, that they think that these tariffs are a bad idea. But yet they don't want to be, abusing their power by saying, well, we're going to punish Trump to put him in his place in order for him to get rid of tariffs. That'd be the end of the Federal Reserve if they want to doing that.
Isn't it so funny how he can float an idea out there and he's in such an echo chamber that people look around him and say, oh yeah, that's a good idea. Punish Trump. It's an awful idea. I don't know what the hell he's even talking about, but I do have a question here. So first of all, there's going to be a question a little bit because I am positioned as if I agree with you on the 3% thing, Bitcoin, real estate, gold, platinum, silver, copper. Those all do really well in a persistent 2.8 to 3.2 range. I think you would agree with that, but that's not going to be my question. My question is this, is that just today, 2 headlines. One from, I think it was IBM, getting rid of their HR department, replacing it with AI, firing 8,000 workers. Goldman Sachs said, I can't remember what process they said, but it used to take a team of 6 a month to get some report ready. Now it takes AI about 10 minutes. Is this
there was a perspective? Yeah, that's a prospectus. That was what Goldman Sachs said. Yes, now they can have a prospectus ready to go in 5 to 10 minutes, where it used to take a bunch of lawyers 6 weeks to put together one.
Okay, so what about that and its inflation implications?
It is important. I'm going to quote Bob Gordon, professor.
I thought it was going to be me. Go ahead.
Yeah. Bob Gordon, professor at Northwestern University. He wrote a book about technological change about 10 years ago. All technological change is a net creator of jobs. Even Uber was a net creator of jobs. The spreadsheet was a net creator of jobs. The air conditioner was a net creator of jobs, depending on what technological change you want to take. I think what you're going to see happen in the future here is, you're going to get rid of the HR jobs. You're going to get rid of the lawyers writing prospectuses. But AI is going to create whole new industries with millions of people employed in those industries that don't exist yet. We don't know what those industries are going to be. It's akin to, where's my stupid phone? It's akin to, here's my phone, that when Steve Jobs held up the iPhone 1, did you say that's the end of the taxi industry? That's going to forever change the hotel industry? Did we know that's going to change the way that we buy stuff? No one knew. This technology that's being unleashed, the problem, as Gordon would say, when a new technology comes in, everybody can see, oh, those are the people who are going to lose their jobs, but they cannot see the advantages that are coming. And the final thought I give you is what AI is also going to probably bring us to, with some of the big strides that have been made by Waymo and Tesla, is self-driving cars. And that's self-driving delivery. And what that's going to do is, that's it. Millions of people are going to lose their jobs as drivers. It's going to so dramatically lower the cost of delivery of anything and everything that there's going to be whole new industries where we make stuff and it's just delivered to your front door for practically no cost.
Delivering people too, cab drivers, delivering people as well. Right.
Right.
By the way, quick aside, Bob Gordon's a Northwestern professor, right?
Yes.
So about 15 years ago, PBS did a thing by David Eisenhower did it. They invited me to Washington because I had written a couple articles on wealth inequality and how interest rates affected that. So I was put on a panel with him to debate it. And these professors, I don't think they like being attacked in that sort of setting. Like you guys would have all been fine with it. So I'm pretty sure that Bob Gordon guy hates me, but that's just my little aside. I did.
They're all like that. They're all like that. Yeah.
Okay. So by the way, I said before, and then Bobby, the next question to you, but I do want to go with, I mentioned my portfolio, which is about persistent inflation. A lot of it comes from Larry McMillan's book. What was that latest book he wrote called When Markets Talk, Listen, or whatever? I'm sure that's a great book, by the way. Do you think those are the things you want to be in a persistent 3% inflation rate?
Me or Bob?
You, Jim.
Oh, me. Oh, okay. I thought you're directing it.
They hear us enough. We want you. Yeah.
No. I think so. I think that in a persistent inflation rate, what I think you're going to see is you're going to see higher interest rates. In this flat curve environment, I wouldn't even be, if you're looking for a safe way to invest in it, start with T-bills, because those rates are going to continue to churn out low fours, which is going to be more than what I think the inflation rate is going to be. After that, I do think that things like tips, things like gold, commodities, those types of things are going to, be better investment choices. When you get to equities, the problem you're going to be facing with equities, but what about industrials or basic materials or energy? They've got valuation problems right now because they've got valuations as if there isn't inflation. And so I think that there's going to be a struggle. But yeah, I do think that the inflation story is going to work. And I think it has been working. You're right. Look at what are the few things that have actually given you a decent return this year? It's been gold, it's been Bitcoin, it's been stuff that you could argue is in the camp of, inflation beneficiaries.
We've got really smart viewers, Mr. Bianco, and I'm going to ask a couple of questions that have been put up. But first, I'm going to read Edward McKernan, one of our regular viewers, and he just posted something on Twitter saying it's the end.
I went to college with him.
Yeah,
you did. You guys, he's a friend of Jay. You guys are on the same floor.
He put something I thought was really, really smart. It's the end of hundreds of dollars spent on airport parking, totally changing airport economics. I guess that's the self-driving cars to the airport and stuff. I'm guessing more with that.
If I could argue to you, the self-driving car is going to it's going to change the American culture.
Yeah.
It's going to be the end of owning a car.
I'm a huge car guy, and I hate that part of it, but I'm a huge fan of self-driving cars.
Yeah, because what'll happen is you won't have a garage anymore.
Yeah.
But think about it this way: it's like Uber in your pocket, except there's going to be 30 or 40 million of them. There's not going to be. There's going to be 3 on every block. You're going to push a button. You're going to push a button, and within 10 seconds, one of them will show up in front of your house and take you to wherever you want to go. And then you'll just push another button when you want to go somewhere else, and it'll take less than a minute for one to show up.
And you think that's 5 years away from this, maybe 10, right?
I don't know. We're not 10.
I don't know. And by the way, Bobby, you know how this is going to work is when they get the self-driving down, and how they're going to push human drivers off the road is the insurance companies are going to say self-driving automobiles, it's $300 a year to insure it because it never makes a mistake. Yeah. And humans, it's going to be $6,000 a year to insure them because they always make mistakes. And so that's how they're going to that's how they're going to drive human drivers off the road. You'll still be able to drive, but they're going to make because you'll be driving with a bunch of cars that never make mistakes.
Yeah.
And so that's why it'll be prohibitive to insure yourself.
There's a couple of questions from Tim, who's a friend of mine and sort of a neighbor down here where I live in Florida. There's also a great comment from Widge. But first, I want to say this. In Southwest Florida, where Tim and I live, and another mutual friend of ours, a guy named John, who's a very, very smart young guy. I was talking to him the other day, and we talked about how in Florida, everybody lives in these communities, right? And it's not like in Illinois, where only the rich people live in communities, like Jim and Jim. Everybody in Florida lives in some sort of community, and there's lower middle class, there's middle class, there's upper class. These communities are going to buy these taxis first, and they're going to make it part of the lure to move into these communities. It's going to be part of your homeowner's assessment, your HOA, right? Where they're going to say, we have 7 Waymos here, or we have 7 Tesla taxis here. You don't need to own a car to live here anymore, which everybody in Florida, for the most part, needs a car because you can't walk anywhere. And we're going to just be, walking over or calling the HOAs taxi over to take us somewhere. And I'm all for it. I am all for it. But I want to ask Tim's question, this first one about the JGB, Luis. Also, Jim Bianco, let Luis know when you want to share your screen if you still do. Tim says, what does the rise in JGB rates mean for the U.S. bond market?
I'll share my screen at the end. It's something for Bobby. It's a gift for you, Bobby, at the end.
Love it.
What's happening with I'll tell you what's happening with the JGB market. First of all, to answer your direct question, I don't think it means a lot to the U.S. bond market because the ownership of JGBs is largely a domestically owned bond market within Japan. There's not a lot of outside Japan owners of that market. So as their rates go up and as their losses in their bond market mount, you're not going to be pointing to American, investors or hedge funds or insurance companies or American banks or European banks or other Asian banks as saying they're on the hook because they own a ton of this stuff and they're losing money, because it's all the Japanese that own it. Now, why are the rates going up? I think it's a very simple story. The Japanese economy had been flirting in and out of recession constantly for about 30 years.
Right.
Their inflation rate had been flirting with zero for about 30 years. Now their inflation rate is approaching 2.5% to 3% consistently for the first time in a generation. And they've got positive growth. Add it all up, where should their 30-year or their 10-year, which is at 1.5%, where should it be trading? It should be trading north of 2%. Well, it's on its way, is what it's doing. It's adjusting to where it should be right now. And so I think what you're seeing in Japan is a normal adjustment. Just we're so used to them having zero negative rates, we can't believe that it's going to be something else. Now, what you might see that could affect the world markets is the end of the yen carry trade. The yen carry trade had always been an idea of borrowing Japan at zero, then go invest that money in a higher yielding market somewhere else. So that, but then you can't take you have to take the currency risk, but the currency was fairly stable. So the popular yen carry trade, I think I talked about this last time you guys were on here, was borrow at zero, buy Mexican T-bills at 10% and take the Mexican yen risk, but it wasn't going to move more than 10%, or wasn't going to move anywhere near 10%. And what I was going to say was the Mexican treasury market is called bonos, and then we can all act like 5-year-old boys when I say the word bono again. Right?
Oh, I will.
Yeah.
Bobby, what's Widge say?
Yeah, real quick, Widge's comment here. There's actually multiples, but I'm going to stop at this next Widge comment and let you talk about the banner. Widge says the current, what is this, big, beautiful bill?
Yeah.
The current big, beautiful bill looks too much like the last big, beautiful bill. So my expectations for inflation have gone up too, especially with the apparent death of Doge. Right now, the deficit's projected at about 6.9%, minus 6.9% GDP versus GDP, which is about a 5.5% nominal GDP to get us to somewhat balance, which is not going to happen in my view. But it's still, I think nominal GDP is running, what is it, Jim, about 4.6% now? Somewhere around there?
Yeah, somewhere around, just around 5, yes.
Yeah, so it's that we're still going to be running a deficit. We're not going to be, as a matter of fact, it's an increase in deficit spending right now.
So let me make a quick comment about that. The current big, beautiful bill looks a lot like the last BBB bill. Does he mean the Build Back Better bill under Biden? Because they both have the BBB.
What he means.
That's
what he means. Maybe.
Yeah, but they both have the BBB alliterations to them, and the Build Back Better bill was an inflationary bill as well, too.
Yeah.
Now the problem, let me just dissect that. The problem with the big, beautiful bill was Trump came in, says he's a fiscal hawk. We're going to cut spending. We're going to bring in Elon with Doge. Elon says I could find $2 trillion of waste, fraud, and abuse. Okay, I didn't believe he was going to find 2, but I thought he was going to find something, and apparently he has. But then none of that made it into the bill. They're not cutting down on spending. They're not taking the things that Doge uncovered and putting it into that bill. Now, newsflash this afternoon, Elon came out today and basically panned the big, beautiful bill, didn't like it, and said that Doge found all this cutting. And late this afternoon, Congress said they're going to do what's called a rescission bill, which is like an amendment to the big, beautiful bill. And they're going to put some of the Doge cuts back in. Now, they got to get it. They got to pass it. But at least they're moving in that direction. They're moving in that direction. And then the final thing I'll say too is 6.9% deficit to GDP. There has only been 5 times in American history it has been that big or larger. In order, in chronological order: the Civil War, World War I, World War II, the worst of the financial crisis, and COVID. Each one of them was a mortal crisis threatening the existence of the country. And yes, COVID did. For a while there, we thought that there was going to be mass death, and we didn't know. at some point early on in the process. But now it's happening in a non-crisis, non-war environment. This is the largest government deficit we've ever seen. And in fact, there's been recessions when the government was throwing money at people to try and get out of recession where the deficit wasn't as big as it is right now. So it is a huge problem. That's why, to come back to what I was saying before, 5% is normal. If you think the big, beautiful bill is going to push interest rates up, and I agree with you, and they're going to go to punishing rates, that's not 5.10, that's 6 is what that is. We're not there. We're not there right now.
Can we take a quick timeout? Luis, will you put up the banner? You guys have given us so much support on this show, and we appreciate it a ton. Luis is about to show a banner for how you can do us a favor and subscribe to Tradier Pro for 3 months free. Luis fall asleep, you think? Luis, wake up, man. There it is. There it is. So there's the banner. So you can subscribe to Tradier Pro for 3 months for free. Absolutely no obligation. We talk to guys who trade options all the time, whether they're beginners, intermediate, or experts. Every one of them who's tried this like this system a lot. We appreciate it. It helps us a ton if you do the free trial. Thank you guys very much. Okay, Jim, this brings up a question about what you just said about the deficits and the debt, and about how this is, to call it unprecedented, which is an overused word. Every couple of weeks, I tweet out that any economist who called the last 4 years of economy a great economy or good economy, but never once tried to reconcile the fact that they were spending money like absolutely drunken sailors to support this economy is derelict, nefarious, or just an absolute moron. Do you agree with that?
Yeah, to some extent. I mean, you know, if you want GDP to be positive, just have the government just basically borrow money and throw it at people.
Right. Yeah.
Yeah. And that's what we've had. But then, of course, that's inefficient spending, and that does lead to some forms of dislocation and inflation. And we've been seeing that as well, too.
Okay.
And this is where the problem comes in, is that everybody is so afraid to touch these third rails in politics, like Medicare, Medicaid, Social Security, disability, and now even defense. Yeah. That the way that they're going to get fixed is what we refer to on Wall Street as the Liz Truss moment. Is that when Liz Truss was the prime minister in the UK 3 years ago, they proposed a bill that was going to increase spending and cut taxes, blow out their deficit. And their bond market rioted. Bond market said, "Look,
fired her."
Right. Yeah. The bond market said, "You're going to have to borrow a lot of money to do that. We're going to need a much higher interest rate." So it collapsed in price, yields soared, created a financial crisis, forced them to not pass that bill. She lost her job. Yeah. We're going to have some kind of Liz Truss moment to stop this. Now that I've said that, the question is when? Is it later this year, or is it in 7 years?
Hold it. Was the 20-year auction on May 21st, to me, that was not a Liz Truss moment by any stretch, but it was a glimpse in demand starting to wane. Now, was that a big deal to you?
It can be. The 20-year auction was very poor, but the 2- and 5-year auctions this week have been okay.
Yeah, but everything closer in has been okay for a long time, though, right?
Right. Because of the flat yield curve, and I think that that gives a lot of people, why buy the 10-year when you could buy the 5-year, the 2-year, and get like 90% of the yield with a fraction of the interest rate risk, or what we call duration. That's why I think that those are very popular. But it's also a bigger problem, globally as well too. This year, globally, sovereign bond markets are expected to raise something like $17 trillion in spending. Basically 17, like 2.5 of it's going to be the US, and the other 15 is going to be everybody else. And that's up from 14 like 2 years ago. That's a lot of money. That is a lot of money that is going to have to be demanded from capital markets to fund government activities. And there's an old saying in the bond market, there are no bad bonds, there's only bad prices. All 17 trillion of those bonds are going to get sold. The question is, what yield are they going to be sold at? And the answer is a higher yield is what it's going to be.
So I got a comment from Widge, Jimmy, that's helping you out. Larry McDonald's How to Listen When Market Speaks.
Why did I call him Larry McMillan? I'm friends with Larry McDonald. I mean, we've seen him a lot of times. I'm sorry, Larry. Yeah.
You call me Bob Barker all the time. So
Bob Barker for sure. Right?
Then I got a question from Tim.
You got to get the microphone.
Yeah,
I got it right. This is all I got.
No, the big long thin one that he used to have.
Oh yeah, I remember. Yeah. Oh
When they
yeah, did he have it in
came
his
out with
hand?
that, I thought the technology was unbelievable.
Yeah.
Then I got a question from Tim about Fanny and Freddie. Any thoughts on releasing Fanny and Freddie from government conservatorship, with Trump saying the implied government guarantee would be staying in place?
That is
I hate that kind of stuff.
Yeah, that is inconsistent. What basically, just so everybody knows, Fannie and Freddie are two unique structures that we've never seen before. They are technically private organizations because they trade equity on the New York Stock Exchange, but they're in a government conservatorship, so the government is running them. Their stock had always traded at around $2 a share as like a warrant or a free option on them going private again.
Mm.
Now, if they go private, that means they're going to be run by a private organization, and that private organization is going to seek to maximize profits, which is what every private organization should do. And that would call into question the reason why would the taxpayer be on the hook to guarantee something that private actors are doing.
Right.
And that's essentially what Trump is saying. You guys go run your business as you want, but if you screw it up, we're already here to tell everybody we'll make you whole. Is what you're encouraging Fannie and Freddie to do is to do the most reckless things that they've ever done to try and create profit and get the stock price up. And that's why they wound up in conservatorship in the first place.
Right.
So if they're going to be private, you've got to get rid of that government guarantee. If you want them to be government guaranteed, then liquidate their stock and make them a government agency. This halfway stuff does not work. And I hope that we don't go down this road again.
There's a question here from Greg I want to ask real quick, and I actually have the answer to it, but you guys feel free to, I think I have the answer to it. You guys feel free to comment. Greg says, if self-driving cars are based on radar radiation detecting objects, how much, with that much radiation being emitted by self-driving cars, will it be safe for humans to even be in a car or even live near a road? So the type of radar that the current self-driving cars use, LiDAR, radio wave radar, cameras, ultrasonic sensors. This is non-ionizing radar. I'm sorry, non-ionizing radiation. So it is generally accepted as extremely safe, not the kind of radiation you think about like with an X-ray machine or nuclear waste. So it is, and I'm not being facetious, the vaccine was safe too. I'm just saying that, this is not, according to current data, the kind of radar. It's not even as risky as your cell phone, according to papers I've read on it. So I'm a big fan of it until I learn otherwise or until I get cancer.
And you expected me to know about the ionizing radar shit? Like, I can answer that.
That's why I jumped in and said I'd answer it. I'm
you
sure
just want to make me
Bianco
look
knows.
stupid. Right?
So I'll say this.
I'll
say this about self-driving cars. Either one of you been to San Francisco recently?
No,
I have.
I have not.
Last year. I see them all the time.
No to people.
Yeah. The Waymo, I'm talking about the Waymo driverless taxis. They're all, there's Waymo driverless taxis all over the place in San Francisco.
Yep.
And I was there 2 months.
Yeah.
Yeah. And they're coming to Austin too. I was there 2 months ago, and I mean, I was at a stoplight. I counted 6 of them, at a stoplight, so these cars, the technology exists. By the way, Bobby, maybe you know more about this. The problem that they're having with them is to get them to work in northern climates when there's snow on the ground.
Yeah.
When there's snow on the ground, then the car gets confused.
There is nothing for the sensor to pick up. They're not able to pick up through snow at this point.
Right. Everything looks the same.
It looks one color. It looks one level. It looks one, height, one depth. It all looks the same when it snows.
Interesting. Yeah.
That's why it's San Francisco, Phoenix, Austin, where they're testing these things right now. But that is another thing that they're going to have to resolve, and maybe AI can help them with that.
That's amazing. Okay. So I've been waiting for this question too. So for 2 years, essentially, my base case has been this, that we were going to get to a time, and you've implied that we're getting closer and closer to it, where the bond market is going to shrug and say, you know what, if you're going to keep spending like you are, we're not going to buy your bonds. My contention is that at that time, the Fed will quietly come back in and start supporting bond markets again. In that case, and it might not show up in the dollar against the euro and the yen because they do the same sort of nonsense. But if it does show up, it's going to show up against, it's going to be your inflation, but it's also going to be gold, Bitcoin, real estate, all the shit like that. So it's a two-part question. One, do you agree with that base case? And two, there's been these whispers that the Fed is kind of slowing QT down. And if you look at the balance sheet, the slope of decline has changed a little bit. What should we know about right now?
To answer your first part of your question, they might try, but they should hopefully have learned the lesson from last year. And what that is remember, September 18th, the 10-year yield was at 360. The funds rate got cut by 50 basis points. And then in November, December, they cut another 25 and 25. What did the 10-year note do during that period where they cut 100 basis points? It went up over 100 basis points.
Right.
It went from 360 to 480 between September and January.
It's not playing.
And
right.
I said really what and let me throw out another statistic and then I'll give you the interpretation. In 2022, when the inflation rate hit 9%, the single highest print in the 10-year note for the entire year was 4.22% in October of that year. We're at 450, 447 right now. Why are we at a higher yield now than when we were in the year that we had 9% yield? Simple answer for you. When the Fed is on the case fighting inflation, the bond market relaxes. When the Fed gives up the inflation fight like they did last September, the bond market worries. So if the Fed wants to under the table QE or try and help bring down rates by stimulating, by printing money or anything else, they're just going to produce higher rates. If the Fed wants to say we're on our way to 6 and on the 10-year note and we don't like it, what could we do to bring the 10-year note down? Hike is what you would do to bring the 10-year note down. Now, where have we seen this in history? The 70s and 80s. That was the mentality of the 70s and 80s. We have forgotten that the Volcker mentality was you want rates down, hike the funds rate. You want rates up, lower the funds rate. So that's, I think, the environment we're in. So that's the fear.
Can I interject something real quick? But the magnitude of the amount of debt we have to roll over now. So it's like, it's not just about borrowing costs for the world. It's about borrowing costs for the federal government. That's got to scare the shit out of the Fed a little bit more, right?
It's got to scare the shit out of the Fed. And the answer would be to turn to the Congress and say, stop borrowing as much.
Stop borrowing. Jesus. Yeah, it's so easy.
Right. Remember the Carville line. Remember the Carville line from 30 years ago? When I get reincarnated, I want to come back as the bond market because you can intimidate anybody. And what that means is the other mistake people make about the bond market is they talk as if it's not a freely traded market. They talk as if, well, the Fed, right. You see, if Besant and Powell and maybe Larry Fink got together in a room, they could decide what level they want to set the 10-year at. They can't do that.
Can't do that.
The 10-year can, that's what Carville meant. The 10-year will do whatever the hell the 10-year wants to do. And you can't stop it, Jay Powell or Larry Fink or Scott Besant. And if you try, you could actually make it worse. So if the 10-year note's on its way up, it's signaling it doesn't like your instrument and it needs more compensation to buy your bonds, a higher yield. So if you want the yield down, you better either issue less, figure out a way to get inflation down, or something else along those lines. Not try to just nakedly manipulate, cut rates, and we'll change the rules so that the banks can buy more. That's not going to work. What's going to work is you have to fix the fundamentals of the market in order to bring it down, not try to manipulate it through some kind of version of QE, Jay, print money and buy bonds, and that will bring the yields down. The problem is in this environment, if he was to try and initiate QE again, people would look at that as being hyperinflationary, and it could actually wind up being worse for the bond market.
Bobby?
Yeah, a couple of quick things because I want to make sure we get to every question. We're running out of time. Tim said, assuming the Fed modifies the SLR rule, which is the it's the strategic leverage. No,
supplementary leverage rate.
Supplementary leverage rule, right? will banks pass benefits along to individual and corporate buyers? Tim, that's a question that helps you. Go ahead.
Yeah. So the supplementary leverage ratio is what the word implies. That after the financial crisis, that they said if a bank were to buy bonds, that they have to take a capital charge against that. What that means is you buy $1 billion worth of bonds, you have to take some money and put it in a cash account, your capital account, in order to cushion against a potential loss. So they made it disincentive to buying treasuries. Now they want to get rid of that rule, and Bessent said that they'll probably get rid of the rule by summer. Well, here's the problem. According to the FDIC, at the end of the first quarter, the banks were sitting on nearly $500 billion of unrealized losses. So I'm going to ask Trader Edge guys this. Here's an instrument that everybody's losing money on. So we're going to lower the margin requirements so you can buy more of it. How's that going to work out at the end of the day? That's essentially what we're saying here. Is I know you've been
break it down. Yeah, exactly.
Right. I know you've been losing shit tons of money on this instrument. Here's a lower margin requirement, so you could do even more of it. My point is the banks aren't going to rush to buy treasuries because you get rid of the SLR. They think it's a money losing instrument. Now, in the future, if inflation comes down or the deficit gets under control or some positive scenario happens with bonds, they may rush in and buy more bonds in the future whenever that occurs, or a recession and they want to just hide in bonds. That could help. But if the argument is they're going to get rid of the SLR this summer while they're passing the big beautiful bill, which is going to be big beautiful spending, and they're continuing to do all this other stuff, that somehow magically everybody's going to say, you know what, we got all these unrealized losses in bonds, let's buy more of them. No, they're not going to buy any more of them.
You guys saw that Trump asked Congress to codify Doge cuts, right? $9 billion.
Yeah, I did see that. I love it. Yeah.
Yeah, he said that. Oh, I just want to read, there's like 3 more questions. And then
go ahead. I'll try and answer them fast.
Well, there are actually more comments than that. And then Jim wants to share a screen. One of them is, where is it? MM79 says, hence why Tesla's self-driving is a vastly superior product. No radar, pure vision, no weird radiation to be concerned about, amongst other efficiencies. The radiation, I don't think we should be concerned. Doug Sarbon says it's a no-brainer. We can't spend our way out of this debt. Tell Congress that, though.
That's a great point, Doug. Tell Congress that. We're logical people here. They're not. But anyway.
Yeah.
Well, you know, in fairness to Congress on that second point,
is there a reason to be fair to Congress?
No, but I will say this. There's been recent studies that been recent polling where people have said 75% of the American public says you shouldn't cut Medicare, because 75% of the American public, you know, it's kind of the inverse of the tax thing, right? When you ask, I've always railed against these things where 80% of the American public says that the rich should pay more taxes. Yeah, because 80% of the American public is not rich. Right. You know, you're saying you've just asked me, should somebody else pay taxes? And the answer is yes. Yeah. Well, it's kind of the inverse of that, because the American public says 75% of the American public is not on Medicare, but then they say, but the people on Medicare are desperate. So I think we shouldn't cut it, you know, and stuff. But then, you know, the problem is that if you actually look at the programs, they're so wasteful and they're so fraudulent to begin with and stuff like that. So Congress hears this, right? 75% of the American public says don't cut spending on Medicare, and they're afraid to do it. So that's what I mean by to be fair with them.
Tim's last comment was that's what Japan did, which I think he was referring to what you were describing with the SLR.
By the way, one other quick comment about the self-driving cars. Yeah. The head of Google self-driving cars, I forgot his name, got in trouble a couple of years ago, where people kept asking him all these scenarios about what would the car do in this scenario? What if there's an accident this way or this way? And he basically blurted out in a moment of frustration. He said, look, human drivers kill 40,000 people a year. All we have to do is kill less than 40,000. And we're ahead of the game. And we're ahead of the game. And, Jimmy Iuorio, see, the problem with self-driving cars is we expect them to kill zero. You know?
Yeah, that's Jimmy Iuorio's response all the time. Is like, look, less people are going to die.
One every 12 minutes in this country dies. Yes.
Yeah.
Right. And if we go to 1 every 15, people will lose their shit because self-driving cars are killing somebody.
Exactly. Right, I'm excited. What did you want to show us? Jimmy.
Okay, show the screen. Jimmy, this is for guys that don't live in Chicago area. Okay. Do you recognize this picture?
Hang on, Luis. What is Luis saying
This
here?
is not shared yet.
It's
This
not
is going to be a
shared yet.
bunch
Bianco,
of almost
hit share on
60-year-olds
that.
having technology problems again. Going, oh, what's that?
Oh,
Press that button.
present, share screen.
Kernan, was he good at technology in college or not?
No. All right. There we go. I'm sharing my screen now.
Technology wasn't even invented when we were all in college.
Yeah, true story.
Can you see my screen yet?
Luis has got to answer in the chat. There must be some issue. Shoot it over to me on Twitter real quick, and I'll put it up.
Oh, it's a pictures of Johnny's. Italian beef.
Johnny's beef.
Yes.
Okay.
And it was a picture of Johnny's of Italian beef in Elmwood Park on North Avenue.
North Avenue. So,
and
is
I was going to
Johnny's
send it.
Movie to show the Bears about or no?
No.
That's
That's
Mr. Beef.
Right.
That's Mr. Beef.
I was just going to find a picture of Johnny's beef and put that up so you people can understand this. This is the thing if people that don't know about Italian beef in Chicago, I don't want to be around you. But the second thing I would say to that is people ask me all the time, what is the best beef in Chicago? And I said, the best beef in Chicago is actually not technically in Chicago. Okay, here it is. I'm going to put it up, Luis, real quick, just so that we don't leave people hanging here. Hopefully mine stays up.
I DM'd it to you. Too, the picture I had.
I think I'm showing a very similar picture. So hold on a second. Let's see. Chrome tab. Here we go. Johnny's beef. This is it. Can you put this up, Luis?
Oh, I've passed it. I love it.
That's it.
That is, it's in Elmwood Park, Illinois. So what would we say?
Right.
It's like 25 minutes. It's actually only about 5-10 minutes outside of Chicago city limits.
But it's about 25 minutes from downtown Chicago.
Yeah.
That's
by the way,
minutes. Actually, I'm going to show your picture too.
Two things about that picture. Oh, you got my picture?
Yeah, I got it. I'm going to share this one because it's a better image of it. Go ahead, Jim.
Yeah. Two things about that place. It is probably the best Italian beef in an Italian sausage in Chicago. And as you throw up my image of it, which there's a joke that goes around with it. What's wrong with this picture?
Yeah.
With my image.
Luis, put up the one I just posted, please. There you go.
That's it. What's wrong with that picture? It's the same place.
Nobody's thin.
No, close. There's no line.
There's no line.
Right,
That
exactly.
is weird.
There's no line.
That is weird.
Okay,
So-
just for accuracy's sake.
So now I wanted to throw this at the guy that lives in Florida. As much as you love Florida, see what you're missing?
Yeah, so I will tell you guys this. All right. So Mr. Beef opened up a little stationary food truck on the south end of Naples. Tim, I've been meaning to meet you there, but I think that they shut down for the season. But that was like a walk down memory lane from 5 years ago when I lived there.
By the
they
way,
had the
they're all
beef,
Vienna
always
beef, though, right?
sausage. What's
They
that?
get their beef from Vienna beef, and their sausage.
Well, I mean, Johnny's roasts it. They might buy their
does it really?
Johnny's
Okay, then
roasts their own. They get their dogs from Vienna beef. Like the Vienna
Right.
beef is not. I don't like the Vienna beef particularly. Now, real quick, Luis, if you could put up Edward Begg's comment up there, because this is going to mean a lot to me and Jimmy. I don't know if it means anything to you, Jim Bianco. Bonacorsi boys run Alpine subs. You remember Alpine, Jimmy?
Oh,
Yeah.
I still talk to Jimmy Bonacorsi all the time.
Yeah. So
Yeah.
when we were on the trading floor, every once in a while, somebody would go, "Hey, these guys are going to Alpine. What do you guys want?" Alpine was another Elmwood Park joint, right? And I don't know if the Bonacorsis bought it or if they were always a part of it. I don't think they were always a part of it.
No, they bought it.
I could be wrong.
The Italian ladies who worked for them couldn't speak any English, and they couldn't speak that much Italian at the time. And he used to tell funny stories about when he bought it. He was like, "Shit, I can't even talk to my staff," but they sure did a good job. Yeah.
Johnny's beef. Any of you make it to Chicago, and if it's a food trek to get the best beef, everyone will say go to Portillo's. It's very good. They'll tell you go to Al's, Carm's, Mr. Beef, which I don't think is open anymore. All those are very good. Johnny's kills them, kills all of them. And Jimmy, there's one in Arlington Heights, and it's legit.
Yeah.
Yeah. So my brush to greatness is, do you remember what was across the street from Johnny's on the other side of North Avenue? St. Vincent's for our church.
Yeah, St. Vincent's. Right.
Yeah, that's where I was confirmed, and I got my first communion at that church.
And actually, Nick and Tony's Pizza.
I grew up in Helmut Park.
You remember Russell's Barbecue? That people don't.
Of course I do. I lived about 2 blocks away from it.
Yeah, Russell's Barbecue is fantastic.
In Kittyland? Should we go to Kittyland?
I remember Kittyland. Yeah.
Kittyland. I would ask my dad every Sunday.
We're gonna drive everybody away from this. We're just gonna sit here.
They've already turned up. We probably got 8 viewers still now.
Kittyland was
they're all from Chicago.
My dad on Sundays, can we go to Kittyland? And he'd say, "We'll see." And after about 2 years, I told my mom, "We'll see" is no.
Right.
No.
Yeah. All right. We got to go. Our producer's got to leave. Thank you guys so much for joining us. This has been Three Negos talking about Italian food, and it's been fantastic. Thank you guys a ton for joining us. The DMs, the retweets you guys give us is humbling. Just that Scott Pelley prick. I don't know if you guys saw him giving his college commencement speech. He's like, journalism is under attack. Yeah, it's under attack because clowns like you broke your sacred oath to the people and started reporting bullshit. We like to create a forum where we might be wrong, but we're telling you our honest opinion and we're not propagandists. Thank you guys so much for joining us. Please join Jim Bianco on Twitter. His analysis is amazing. This has been The Trader's Edge.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.